Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host here at AlgoBot, and today we're studying an expert advisor called VWAP Imbalance Fade Hedge. This is a pure price action strategy. There are no moving averages, no oscillators, and no classic indicators at all. Every decision is built from raw candles, an intraday volume-weighted average price, fair value gaps, and engulfing patterns. By the end of this video, you'll understand how the strategy spots an overextended move, how it fades that move back toward fair value, and how its recovery hedge is designed to respond when price keeps running. Let's dive in. So what does this expert advisor actually do? At its heart, VWAP Imbalance Fade Hedge is a mean reversion strategy. The core idea is that, inside a normal trading session, price tends to oscillate around the day's volume-weighted average price, often shortened to VWAP. You can think of VWAP as the market's running fair price, weighted by how much volume traded at each level. The strategy re-anchors this VWAP at the start of each new calendar day and rebuilds it bar by bar from closed candles only. When an emotional thrust pushes price an unusually long distance away from VWAP, that move is often overextended. The strategy measures that distance using its own volatility unit, which is simply the average candle range over a look-back window of bars. If price has stretched far enough beyond VWAP and then prints a reversal candle, the approach assumes the auction has rejected the excursion and that price tends to drift back toward the mean. Fading that rejection back toward fair value is the trade. Because it reads only raw price, this expert advisor works on any symbol and time frame you choose to test it on, from major currency pairs to indices and metals. It runs on a single primary time frame, the one you attach it to. It's designed for traders who are curious about market structure and price action concepts like fair value gaps, engulfing patterns, and swing support and resistance, and who want to see how those ideas can be combined into a rules-based system. One important detail sets this strategy apart. Every fade carries a built-in plan for when it is wrong. The classic weakness of any fade is the day the move is a genuine breakout that simply keeps going. Instead of only absorbing that loss, the strategy can arm one opposite recovery hedge once the move has run a set distance against the original position. We'll explore exactly how that works later. As always, remember that this is educational information only, not financial advice, and that trading carries real risk, including the risk of loss. Let's walk through the exact logic, step by step. First, the strategy maintains two reference values. It re-anchors the volume-weighted average price at each new calendar day, accumulating the typical price of each closed bar, weighted by tick volume. It also calculates the average candle range over the look-back window, with a default of 20 bars. That average range becomes the strategy's volatility unit, the yardstick it uses to measure everything else. Now for a long entry, three conditions must line up. The first is stretch. The just close bar must close below VWAP by at least the stretch multiple times the average range, with a default of 1.5. That tells the strategy price has traveled an abnormal distance below fair value. The second condition is a bullish engulfing pattern, where the most recent closed candle is bullish and its body fully engulfs the prior bearish candle's body. That signals buyers stepping back in. The third is confirmation, and the strategy needs at least one of two things here. Either there's a recent fair value gap, which is a 3-bar imbalance where price displaced so fast it left an unfilled void, or the signal bar tags swing support, meaning its low reaches down near the lowest low of the look-back window. When stretch, the engulfing pattern, and at least one confirmation all agree, the strategy opens a buy. The short side is the mirror image. Price must close above VWAP by the stretch amount. The most recent candle must be a bearish engulfing pattern, and there must be either a fair value gap in the up direction or the bar tagging swing resistance. When those align, the strategy opens a sell. Risk control is structural. For a long, the stop is placed below the lower of the last two candle lows, padded by the stop multiple times average range. The take profit sits at the reward ratio times that risk distance, defaulting to 1.6, aiming back toward and through VWAP. The short side mirrors this above the market. Finally, the recovery hedge. If a lone fade runs against the position by the hedge trigger multiple of average range, and no hedge yet exists, the strategy opens one opposite leg with its own stop and a breakout target. If price instead snaps back before that target, the hedge is closed early so the original fade can continue toward its goal. Let's read the actual MetaQuotes language code on screen, just as you'd see it in MetaEditor. At the top are the inputs you can adjust. Range lookback, defaulting to 20, sets both the volatility unit and the swing window. Stretch multiple, at 1.5, controls how far price must travel from VWAP. Reward ratio, at 1.6, sets the take profit relative to risk, and hedge trigger multiple, at 1.2, decides when the recovery hedge arms. Now look at the long block. The condition reads, if stretch below is true, and a bullish engulfing is true, and either at support or a down fair value gap is true. When all of that holds, the code calculates the stop loss as the minimum of the current and previous lows, minus the stop multiple times average range. It works out the risk as the distance from the ask price to that stop, then sets the take profit at the ask plus the reward ratio times risk. Finally, trade.by sends the order with that stop and target. The short block is the exact mirror. If stretched above, a bearish engulfing, and either at resistance or an up gap all agree, the stop is placed above the higher of the current and previous highs. The risk is measured from the bid up to that stop. The take profit is the bid minus the reward ratio times risk, and trade.sell places the order. Both sides use the same structural, volatility scaled logic, just flipped in direction. Let's bring this to life on the chart. Across the candles, you'll see a single blue line winding through the middle. That's the VWAP, the strategy's day-anchored fair price, and everything keys off how far price strays from it. Notice there's no oscillator panel here, because this strategy reads pure price action only. We open near the VWAP line, calm and balanced. Then sellers take control. The second and third candles drop sharply, each closing lower than the last, and price pulls well below the VWAP line. This is the overextension the strategy is watching for. Watch the gap that opens between these falling candles. The high of the later candle never overlaps the low of the earlier one, leaving an unfilled void. That void is a fair value gap in the down direction, and it counts as one of the two confirmations the strategy needs. By the fourth candle, price has stretched below VWAP by more than the stretch multiple of 1.5 times average range, and it has tagged the lowest area of the look-back window, which is the swing support. Then the reversal prints. That fourth candle opens lower but closes strongly higher, and its body completely engulfs the prior bearish candle. That's a bullish engulfing pattern right at support, with a fair value gap already in place. Stretch, engulfing, and confirmation all agree, so the buy entry marker appears. The stop sits just below the swing low, padded by the stop multiple, and the take profit is set at 1.6 times that risk, aiming back toward the VWAP line. Now follow the next two candles. Buyers carry price back up, candle by candle, climbing toward fair value. As price reaches the VWAP line, it meets the take profit target, and the long trade closes at its profit goal. That's the full mean reversion cycle, a stretched move snapping back to the mean. Momentum doesn't stop there. Price pushes through VWAP and keeps rising. The 8th and 9th candles surge upward, and again you can see an imbalance forming as price displaces quickly, this time leaving a gap in the up direction. Now price is stretched well above the VWAP line into the swing resistance area at the top of the window. This is the short setup building. On the 10th candle, the reversal arrives. That candle opens higher but closes lower, and its body engulfs the prior bullish candle, a bearish engulfing pattern right at resistance, with an up gap behind it. Stretch above VWAP, the bearish engulfing, and confirmation all line up, so the sell entry marker appears. The stop is placed just above the swing high, and the take profit again sits at the reward ratio below entry, aiming back toward fair value. From there, sellers take over. The final candles ease price back down, step by step, until it returns to the VWAP line, where the short trade reaches its take profit target. Both trades followed the same simple thesis. Price stretched too far from fair value. A candle pattern signaled rejection at a structural edge, and the strategy faded the move back toward the mean. And remember, not every setup behaves this cleanly. When a move keeps running instead of reverting, that's exactly when the recovery hedge is designed to respond. And that brings us to the end of our breakdown of VWAP Imbalance Fade Hedge. We covered how the strategy anchors a daily VWAP as its fair price reference, how it measures overextension using average candle range, and how it combines stretch, engulfing patterns, fair value gaps, and swing support and resistance to fade a move back toward the mean. We also looked at its structural stops, its reward to risk take profit, and the recovery hedge that responds when price keeps running. Remember, everything here is educational information only and not financial advice, a recommendation, or a solicitation. Trading carries real risk, and losses do occur. If you found this analysis helpful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment with the strategy you'd like us to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.